Just a general disclaimer, as always, this is not financial advice, it's purely educational. So I will answer questions that you do have as well. I will not be able to help you with your portfolios, if that makes sense, but what I will do is give you as much information as I can possibly give you so you can make some more informed decisions about your own investments and your own living annuities. Hopefully the information I'll share with you today is valuable. So the first question I think that one might ask is, what is an annuity? And so there might be people on this call of varying degrees of financial literacy, so I don't want to assume everyone knows what an annuity is. So firstly, just as an explanation, it's a life insurance product that pays an income at retirement. So an annuity, a life annuity or a living annuity, they are not retirement fund products. It's actually governed by the Long-Term Insurance Act, like an endowment, for instance. However, the only money that can get in there in a living annuity, for example, is money that has come from a retirement fund. And so you will use one day at least 2/3 of your pension fund or your retirement annuity or a provident fund to purchase an annuity. That is the law. It has to be done, and there's unfortunately no way around it unless your retirement funds are below a certain value. But there are two types of annuities. I briefly mentioned them now. The one is a life annuity. And what is a life annuity? So it's very confusing, the language we have in financial services. A life annuity secures you an income for the rest of your life. And it pays a retirement fund lump sum to the life insurer. That is what you'll do at retirement. You will take that 2/3 at least, and you will pay it to the insurer, and then they pay you an income for life. And that lump sum is gone for life. And so this is kind of the wordplay that I used in the beginning of my career many years ago to try and remember the difference between the two, simply because the one is a life, it is for life. Everything you do is a lifelong decision. So you give your money and you get an income for life, but the lump sum is gone for life. The other option is a living annuity. And the living annuity is what we're going to talk about mostly today. I will probably in the future do another follow-up on life annuities, but then also about how to blend them with living annuities or create what is sometimes referred to as hybrids. So a living annuity, what happens with that is that you invest money, you take your lump sum, if it's at least 2/3 of your retirement fund, and you invest it to provide an income. So it is not given to an insurance company to provide an income for life, it is invested. As per the legislation for a living annuity, you need to draw income of between 2.5% and 17.5% per annum of the total value of the annuity. Personally, I think to have a minimum of 2.5% is quite ridiculous. I think there should be a minimum of 0%. It used to be 5% minimum, up to 20%. But that was obviously back in the days when everybody just got double-digit returns without any sweat. And so years ago, they changed it. They brought it down to 2.5%. So you have to withdraw income from this, unfortunately. It is not guaranteed. And so if the capital in your living annuity runs out, your income stops. Anything that's left over, any capital that is left over upon death can pay to beneficiaries. So it's a nice way to make sure they get some liquidity, get some capital paid to them, and they don't really have to worry about anything else. They don't have to, it doesn't have to go through like an executor or anything like that. But the enemies of a living annuity is inflation and volatility. And we're going to delve into both of those topics pretty deeply just now. So an easy way to remember life annuities, as I said, you get an income for life, your lump sum is gone for life, and it's guaranteed. Living annuity, it's an investment. Every year you've got to amend your income levels. You've got to manage that investment. It moves up and down the whole time. So it's kind of a living, breathing thing. It needs your attention. It's kind of difficult to manage. And that is maybe an easy way to remember the difference between the two. Give me a sec quickly. Somebody wants the invite to get in. So I'm just going to copy it and give it quickly. Okay. Great. So those are annuities, the two types. So let's jump right into living annuities. So you're going to DIY, maybe you're going to set up a living annuity for yourself. The first thing you need to ask yourself before anything else really is, how much income do you need? In other words, how much will you withdraw from your living annuity? The terminology for this is often called a withdrawal rate. It's called a drawdown, an income draw, whatever the terminology. We need to understand how much you want to get out of it first. And this is step one, and I'll show you why now. So just as kind of a rule of thumb, it's different for everybody, but you might want to then take your monthly living expenses. You work that out, and then you add on top of that PAYE or income tax, and that will give you your gross income that you require. So you can go onto a website like taxtim.co.za. They've got an income tax calculator, and so you can work out, you can kind of work backwards as to what your gross income needs to be when you see how much PAYE is taken off. And so that'll give you an idea of roughly what income you require every month on a gross basis. Then what you do is you just multiply that by 12, obviously, to understand what your annual income amount is. Now you know how much you need to withdraw from your annuity, and then you want to probably peg it against a withdrawal rate. You want to know in terms of percentages, how much of my fund, my portfolio, am I withdrawing every year to pay myself? And so what you do is you take your annual income figure, you divide it by the total capital value, and that will give you a rough withdrawal rate. Why is it important? Well, firstly, you want to know if it's maybe too much. So anything above 5% a year from the age of 65 onwards is on the high side. You really want to keep your income a bit lower than that. So like 4.5 or 4, depending on your wealth. And you can start at 5%, you can start at 6%. But then you will know that the future of the longevity of your capital, it might be at stake. And so this handy table that I took from literature provided by 91 investment platform, this is created by a CISA. And a CISA is an industry body that oversees a lot of the things that we do. And so this is kind of like a one-size-fits-all guide to withdrawal rates and how sustainable they are. So on the left-hand column, what we have here is different withdrawal rates: 2.5, 5, 7.5, 10%. And so let us look at an example of 5% withdrawal rate. Then on the top arrow here, and I'm actually going to change this to a laser pointer. There we go. And on the top row here, we have the investment returns per year before inflation, but it's after all fees. So after your advisor's fees, after the platform fees, and anything else that might be accrued. Then what you say is, okay, fine, maybe it's 7.5%, 7.5% after fees. At a 5% withdrawal rate, and you match the two up. And what this table tells you is that at 19 years, in the 20th year, so after 19 years, your income will have to start reducing because you would have reached your 17.5% annual withdrawal limit on the living annuity. Now, returns don't come in a straight line, but this is just assuming that they do. And so you might say, okay, fine, well, I will target returns of 10%. And so 5% withdrawal rate, 10% return, and you will look at 33 years before your income starts reducing. So that's not bad. That's pretty good. And this is kind of like a 5% to 5.5% is a very common scenario I find for retirees about 65 years old. And if we can't get to that scenario and the person needs to withdraw at a higher rate, then we just have the discussion about the trade-offs. What do you have to maybe give up in terms of your living expenses? Or are you happy to take on potentially more investment risk, so to speak, more equity allocation to try and get this number to last as long as possible? We want a big number here. And so for the privileged 0.01% of South Africans who can maybe afford to retire and withdraw at 2.5%, they really don't have concerns. I mean, that money can almost be kept in cash and they will be fine. So I told you we first need to understand how much you need to withdraw, so we know how much of the fund you're taking out every year. You're withdrawing 5%, for instance, or 4.5% rather. Then what we do is we say, fine, let's just say you're withdrawing 4.5%. What investment return must you target? So if we assume an inflation rate of, say, 5% over the next 20, 30 years, 5% a year, we add your withdrawal rate to that, which is 4.5%, and then you get to a 9.5% per annum after fees that your investment needs to produce. Why do we add the inflation rate to the withdrawal rate? It's because every year you want your income to increase with inflation, so you can keep living the life that your lifestyle. You want to maintain your lifestyle. So if you try and maintain your lifestyle, you say, fine, I want a 5% increase in my income every year, and I'm taking out 4.5%. That means the investment will reduce in value by 4.5% anyway, regardless of investment returns. So over and above that, after fees, it must grow by 5%. And so next year, you can increase it by 5%, and that 4.5% is basically static. In a perfect world, with completely linear investment returns, that is how it would work. And so if you take 9.5% and maybe the investment platform charges 0.5%, you're targeting 10% a year in returns. And so then you would need to understand, well, fine, now I know what I need to target. I then need to understand how much equities I need in my portfolio. The higher target, the more equities. And I think that's quite logical. I think we all understand that premise. And so these are just a few kind of guides that we might utilize in financial advice. If you're targeting inflation plus 5%, you're looking at plus minus 75% equities. Probably no more than 75% equities, to be honest. And so that is perfectly in line with the retirement, the balanced type funds you might get in your RAs or your pension funds. So if I mention just a few names, you could have like an Alan Gray balanced or a Coronation Balance Plus or 91 Opportunity Fund. Those target inflation plus 5. Then inflation plus 4 will be funds that have the word moderate in their name. Inflation plus 3 would be funds that have the word cautious in their name. And then when you start getting lower, you can start getting into the bonds and money market space, and equities will be quite low, negligible. And so that is why we determine the income. It always starts with how much you need and what this money is meant to do for you. And then thereafter, what we do is to try and match that with a strategy. Okay. I'm going to get into two topics now. Firstly, the first one I'm going to talk about is withdrawal strategies. And what I mean by this is now you've set up your portfolio, you're targeting inflation plus or whatever, and you're withdrawing X amount from your living annuity every year. How do you withdraw? Where do you withdraw the money from? This is a big question. A lot of work has been done on this in the industry, in the investment industry, to work out how's the best way to take money from your living annuity and put it into a bank account. Do you take it from one fund? Do you take it from all the funds? What is the strategy? So there are two predominant strategies that I'm aware of and that are most commonly used. The one that I believe that almost everyone utilizes, especially when they set up their own portfolios, is called the bucket strategy. So bucketing is very common. And the reason why is because it just makes sense. It seems logical. And so what it does is you take your portfolio and it has different components. You will have the income portion, and then you'll have the growth portion of your portfolio. So now this is your living annuity, and let's say there's 10 million Rand in here. You're going to have, like, say, I think I put in this example, I programmed 15% in here. And say you're withdrawing at 5% a year. So that's 3 years worth of income you've put here in cash, which is money market. At the moment, that's getting you like 8.5% without sweating. And so you've got 3 years, 2 to 3 years of income in this block, this bucket. And then you've got bonds and equities here. These are just fictitious amounts I made up. They mean nothing. But what it's saying is that the rest of your portfolio is sweating. The rest of your portfolio is working while you are reducing this over 3 years to potentially probably zero. Now, this strategy is very commonly implemented. It does have its pitfalls, though. It does have its downfalls, and I'll get into that just now. But this strategy, it makes a lot of sense, especially in terms of behavioral finance. And what we mean by that is we all, as humans, do a lot of mental accounting. And so what we do is we bracket or envelope things. Like we take money and we put it into a mental envelope. This is my emergency fund. This is for this. This is for that. That's quite a normal thing to do. And we're doing it here with living annuities as well. Many advisors will do this with their clients. And it's also to help you manage your expectations when the markets are not doing well. If you remember April 2020, due to the pandemic, we had the most aggressive, the most sudden market crash in recorded history, and equities over here dropped by something like 30% in a month, I think even shorter than that. And so a lot of people might say, well, that's fine. I can see this equities pillar going bananas, but I'm drawing income from my cash, so I'm comfortable and I'm happy to just keep this going. And then after 3 years or 2 or 3 years after you've run this down, you'll take money from this growth element, the bonds and the equities, and you'll bring it across and you'll top up. And so for 2 or 3 years, you withdraw from this one block, and these other blocks, which are the bulk of your portfolio, are hopefully growing. And then you take money across every 2 or 3 years or so. You might even do every year, just top it up, just top it up, just to keep it going, to make sure there's always a nice component there. There's a risk, though. There are a couple of risks with this. Firstly, I don't know how else to say this, but you really have to be on it. You have to watch this, and you have to make sure you routinely rebalance your portfolio. And when I say rebalancing, if this is 15%, if this cash element, this money market element is 15%, you've got to make sure you try and keep it there roughly. And the reason is because once you start running this down and it becomes 10% and then 5%, and if you run it down to zero, which according to some is how they do it, and I've even seen it in literature that it's the way to do it. The problem is you've actually changed the complete asset allocation profile of your portfolio. Your portfolio is designed to have different blocks, different building blocks of asset classes, maybe a bit of property, a bit of local and foreign equities, a bit of cash and bonds. And now you've taken just one asset class completely out of the picture, or you've run it down quite a lot. And so that makes this whole portfolio in general susceptible to a lot of volatility, because you could be a retiree and you have a lot more equity, proportionately speaking, than you did at the beginning of the term. And that could be quite dangerous. Another problem with this potentially is you run this down over 2 or 3 years, and then right at the end, when you're just about to take a big chunk of equities and bonds and bring it across to this cash portfolio, which is now your piggy bank, you have a market crash. And so your equities are down substantially. And now you're going to have to lock in some losses and bring that money across. So the system works nicely as a withdrawal strategy for, I think, behavioral reasons, but you've got to be on it. You've got to probably rebalance every year. You can't let it run down too far. And you've got to make sure you bring it across from the growth that you see in bonds or property or equities, not just from any indiscriminately taking it from any portfolio, but you've got to take it from the growth of those. So if one of the asset classes has not grown in that period, then you leave it. It needs time. It mustn't be touched. The asset class that has grown must be taken. So that's the bucket strategy. But now you get something else called the total return approach, or the total return strategy. And so this is a bit different. It's a bit more of a modern way of working, I think, as well. And so what you will do is you will have one bucket of money. It's just your entire portfolio, and it will be made up of these different building blocks. You will have cash, you will have bonds, you will have equities. Within here, some will be local, some will be offshore. And so you will have this nice diversification, but your income is taken proportionately from each asset class. So if you'd withdraw 5% a year from your portfolio, every month, a 12th of that 5% will be taken proportionately from each of these. And so if this is 15%, if cash is 15%, it would be a 12th of 5% of 15% will come out of money market. And then a 12th will come out of this bond section proportionately. So this might be, for instance, 30%, and then the balance will come out of equities. And so it always reduces proportionately across all the asset classes. Something that's quite nice about this is that the investment platforms, they all allow you to choose where you want your income to come from, the underlying fund, and they have the option of a proportionate income withdrawals. So it is built into the systems because they know that it's a very popular method of withdrawal. And so in the modern era, this has become, as far as I can see at least, a much more popular way of withdrawing. How this would work is you would withdraw a little bit from each, proportionately from each asset class. So each asset class maintains its weighting. You're not running one asset class down. And then any growth that happens within each asset class at the end of a particular term, so it could be a quarter, could be an annual basis, there will be a rebalancing within the portfolio. And when the rebalancing happens, if equities have grown, and now say equities were 60%, but now equities have been running, it's a bull market, and now they're actually 65% at the end of the year, proportionately speaking, money market and bonds are smaller, right? Because they have not grown as fast. And so what they do is they will say, okay, we need to top those two up with in total 5%, because out of 100%, there's only 100. So some of it has been taken away. And so what will happen is you say, fine, let me take the equities, the growth there, sell out the 5% and top up the lesser performing asset classes. Now, this is perfect because what's happening here is you are selling high and you are buying low. The underperforming asset class will be topped up, and the overperforming, or the outperforming rather, you can never overperform, but the outperforming asset class, there will be losses, or rather profits will be locked in. Now, if you invest in, for instance, one fund, and I'll pick on them because they're the biggest fund in South Africa. So if it's the Alan Gray Balanced Fund, for instance, if you invested in there, it will have a makeup that looks similar to this. It's got equities, it's got money market, it's got bonds and everything. And so if you withdraw from that one fund every month, that fund manager will always keep asset allocation within the tactical and their strategic targets, because they can't let that fund grow. Like they can't let the equities run too much. If they let, for instance, equities run too much, it might go beyond 75%, and therefore it's no longer compliant with the Regulation 28 of the Pension Funds Act, which limits the exposure to certain asset classes. Or if money market and bonds run too much for a while, it will start changing the risk profile of this whole portfolio. And so you will have automatic rebalancing happening for you. You don't have to do anything. Secondly, many of us financial advisors will work with a multi-manager, a discretionary fund manager. They will build a portfolio for us, for our clients. And what they will do is they will have maybe 5 or 6 or 10 funds in there. And then every quarter, they send out an instruction to all the investment platforms where their funds are. And they say, do a rebalancing. And the rebalancing brings it back to its strategic asset allocation. And so it is rebalanced for you. And when it's rebalanced, growth gains are taken to fund the asset classes that did not perform as well. Now, you won't believe it, but that is exactly what you're doing here with the bucket strategy. It's exactly the same thing. In fact, the research was done by an American business called Kitces, Michael Kitces. He consults to financial planning firms. And in our environment, he's kind of like a guru, yeah, for financial planners. And they took, in terms of linear returns, they took a bucketing strategy and a total or an absolute return strategy. And what they did was they mapped them out, imagining every year at the same date a rebalance happens. And when the two lines came together, the two graphs, they were perfectly in sync. So we're doing the same thing, but it's less work, it's less admin when you do it proportionately. But you do take income from all the asset classes. And for a lot of people, that seems to be quite confusing, or it seems to be counterintuitive. However, it is a more widely accepted way of withdrawing income at the moment. So both methods, if you choose the one or the other, both methods rely on rebalancing. So if you go the DIY route, and if I go back here quickly, and you make your own buckets up and you've created your own portfolio on a platform, like I mentioned before, I can't emphasize the importance of being on it and making sure you rebalance, to set rules in place and you make sure you do it no matter what. Because that is the number one point of this, is to make sure that you have a good distribution of your asset classes. And so you rebalance at least annually, even though you might have 3 years worth of income there. There's no difference in outcomes if both are managed the same in terms of an annual rebalance, or if they're both quarterly rebalanced. There should be no difference in outcomes at all. And so rebalancing is actually very important to mitigate your sequence of returns risk. Now, I'll explain this term to you. Let me break it up for you. Sequence of returns. So the order of events, the order of returns. When I talk about investment returns of, say, 10% per annum, that might be an average over, say, 10 years for a particular portfolio, but it doesn't come 10%, 10%, 10%. If something gives you something like that, it might be a Ponzi scheme. What it is an average. And so one year you might have negative 20%, and the next year you might have positive 35%. And so you have this, what I always call like a shark's teeth. A lot of the investment track records, when drawn on a graph, an XY axis, it's not a line, it's like this. Hopefully it always trends upwards. And so you have this jagged line that trends upwards. Now imagine you start your living annuity now, January 2024, and in year one, there's a market crash, and you've got 70, 80% maybe equities. Now there's going to be a problem there. Firstly, your equity value will drop in proportion to the 100% of your portfolio, but the cash and bonds maybe, although bonds these days are no longer really uncorrelated, but they might have done well. And then you've got a portfolio that is very bond and cash heavy, and proportionately it's very low on equities because there's been a massive crash. Now you leave it like that and you don't rebalance it. Your equities might have been 60% before, but there was a market crash and it halved, and now the equities are 30%. Now only 30% of your portfolio will start taking part in the bull market, the recovery from this crash. You've got to rebalance pretty quickly. So you don't know when to rebalance, so you just do it according to a rule, and you do it regularly. And so when you're rebalancing, maybe your bonds spiked and you got a nice return there, and your money market, the interest rate probably has gone up in that environment. And so you've made some nice gains there, and you take those gains and you throw them into equities. You're selling high and you're buying low. And so then you rebalance the portfolio, and now you've got 50% or 60% again equities in your portfolio, and you can fully participate in the upswing, the recovery. So rebalancing is very important. Many financial advisors, many financial planners do that for their clients. But if you outsource investments to a proper investment firm, it gets automatically done within the portfolios. And you cannot believe how important that is. As I said, the bucketing approach, if you fall asleep at the wheel and you leave your buckets unattended, it will be disastrous. It'll take decades off of the longevity of your capital. So if you want to know more about that, there is a source here. I know it's like super small. It's a link here. But for anyone who's interested, I can include the link to this article from kitses.com that breaks down these withdrawal strategies. I can include it in a mail. I've even downloaded it from the web, and I've got it on a PDF as well. Extremely interesting reading, and it's something that we as financial advisors will always look at as well. I see I've got some questions. I will get to them right at the end of the last few slides. I think we've got 2 more. So we are kind of flying through it. I think you all can unmute yourself. So if there's something that's like really pressing, just jump in and just unmute yourself. There's only 4 of you on the call, so it should not be too chaotic. Okay. So we talked about withdrawal strategies. Withdrawal strategies, if you have a good investment portfolio, into withdrawal strategies is most of the work because the portfolio is hopefully being managed well. But you can, with the living annuity, invest any which way you want to. Retirement funds are limited in their allocations. I mentioned earlier on Regulation 28. You can only have 45% offshore in retirement funds and up to 75% in equities in retirement funds. With a living annuity, you actually can do whatever you want to. And so what I have seen before on social media and generally in articles like on websites like MoneyWeb, I think, is people writing opinion pieces or asking for advice and being told, invest offshore, invest everything offshore. And so living annuities give you the option of investing as much offshore as you want to. So do you invest 100% offshore and mostly in equities in living annuities? Now, I think this is actually a very topical question because of the sentiment around South Africa. And so people want to externalize money as far as possible, to get it away. Although you can't really go directly into dollars and that within a living annuity. But what you can do is you can go through feeder funds or asset swaps. And so your money will be abroad in dollars, but it goes through the company itself and they make the switch for you. And so a lot of people say rather invest offshore. And as always, we all know, I hope, that over the long term, nothing produces superior returns to equities. So it makes sense that a lot of South Africans, especially given the climate, would say, go offshore as far as possible and invest in equities. So I want to show you this graph. And this graph is, I can talk on this topic alone, how much offshore allocation to have in a living annuity for probably 3 to 4 hours. It is one of the most researched topics in South Africa. This graph is from 91. Again, they've produced some amazing research, and I am crediting them here because they deserve it. And so I'll explain this graph to you now. These are annuity failure rates for different levels of offshore exposure and differing starting annuity income levels. So let me translate that. The rate, the degree, or the chance of your living annuity failing based on offshore exposure, and also the different withdrawal rates that you start off with. So on the left-hand side here, it is the failure rate. You can see it starts at 0, goes all the way up to potentially 50%. And this is how many of the case studies would fail based on this asset allocation. The horizontal axis, it's the proportion of the portfolio in offshore equities. Proportion of the portfolio in offshore equities. You see it goes up to 70, I think it's 75%. It's very small on my screen. And then here, these different lines, these 4 lines are different withdrawal rates at the inception of the living annuity. At the bottom, you see it's 2.5. These guys are always safe, regardless of what happens. Then you got a 4.5, which is now becoming real life. 5%, most South Africans are privileged if they can start at 5%. and then 5.5. So 5.5 and 5, there's not much of a difference in terms of percentage. It's obviously just a little bit more. But this is extremely interesting. So I'll break this down for you. Let's use 5% as an example, because this is a very common withdrawal rate. You can see with minimal offshore equities, there's almost a 30% failure rate. So that's not good. And then as soon as some offshore equities is introduced, it falls off a bit of a cliff here and it starts going down. But as soon as we get to about 50 or so, 55, you can see this line where my laser pointer is, it's starting to flatten. It's becoming less healthy for your portfolio. And then from 55 upwards, it is catastrophic for your portfolio. 55% of offshore equities is catastrophic for South Africans and living annuities, drawing at 5%. It gets worse for those who are withdrawing at a higher rate. So 5.5%, and there's not much difference between 5 and 5.5, as I said. The sweet spot is actually about 35 to 40%, because you can see thereafter, the failure rate starts increasing, and then at 55, it's terminal. It's a death sentence. Now, this is dramatic language, but this is a dramatic topic because it's all of your life savings. And so a lot of South Africans believe that you must go 100% offshore. And this is counterintuitive once again. It doesn't sound right that the fact that you're exposed to offshore equities, more opportunities to be invested in companies that are available in Asia and the States and Europe. But you can see how these portfolios fail. Now, this is not just 91. 91 just articulated it very well in this graph. Most investment houses have done research like this. And their conclusions have all been the same. The reason why it fails so dramatically is because offshore exposure increases volatility. At the beginning of this presentation, I said inflation and volatility are the enemies of any portfolio that you withdraw an income from. So it's not just living annuities, but living annuities are the most common portfolio you would withdraw an income from. But you could have unit trusts, you could have an endowment, and now you're saying, I want to start drawing an income. Volatility is a problem. And the reason is because every year, if you follow my laser pointer, every year you take out 5%, you take out 5%. And then in that year, you might have had a 10% downturn in the markets. You're actually down 15%. Not 10%, you're down 15%, but you took 5% out. Now, as you know, a 15% return will not get you back to where you were before, because now it's 15% of a lesser amount. So you need to get a higher return, probably like 18 or something. So the bottom line is that the more volatility you have, the worse it is for the longevity of an income drawing portfolio. And offshore exposure creates volatility. And the reason is because the rand is quite a volatile currency. In the trading world, they refer to the rand as the ropey rand. And the reason why they refer to it as the ropey rand is because, you know, if you take a rope and you wiggle it up and down, it creates that like sound wave pattern. And that's what the rand does. And we know this because if you've got any business interest offshore, if you do any importing or exporting, you probably watch Forex quite a lot, and you see this thing bouncing up and down. So it's an extremely volatile currency. And so all of the research across South Africa, it points to equities being around about up to 40% offshore equities, that is, being ideal for portfolios from which you draw an income. Now, it obviously does vary a little bit. If I quickly go back to that slide and you see 2.5, doesn't matter. But the other ones, you can see there's actually a bigger sweet spot. So if you have a 4.5 withdrawal rate, you've got more leeway in terms of offshore equities. Not many South Africans are there, though. So many South Africans start drawing at 5%, but I've had to help many clients at 65 years old start at 6 and 6.5%. And so there you've actually got to keep the offshore exposure low. Currency risk is as high as equities. Now, this is actually a quote from Old Mutual Wealth, their CIO. And what he said was, global cash, so US dollar money market, is as volatile as a local equity once it's translated back into rands. Now, you might say, well, it's fine. I don't care if it's translated back into rands. The thing is, if you're withdrawing an income in South Africa, you're using rands. And so you need whatever you do, however you invest, it must make sense in rands. And so regardless of one's opinion about the country and all of that, we might have strong feelings, but unfortunately these facts, they don't care too much about the feelings, and they just operate as a function of the market movements. And unfortunately, our currency market is extremely volatile. Another quote from another fund manager says, "We can only aim to preserve capital in one currency at a time." And with a living annuity, it's all about capital preservation. You need that capital to last. You want it to last. If you retire at 65, you could live to 95 easy. Our base case for clients is generally to plan until triple figures. My Oma, is now going on to 92. And so it's a real thing. Longevity is a real thing. And so your capital has to keep up with you. This is obviously not relevant for people withdrawing at 2.5%. Like I said, nothing really phases them. And then also for expats. So when it comes to expats, if you're living abroad and you've emigrated and you've got maybe like a small living annuity left here, you're going to externalize that money once you withdraw that income. So you're going to turn it back into dollars anyway. Now, when you invest offshore, there's a few, and for all of you on the call, if you have offshore investments, there's a few rules to think of if you don't do this already, and I'm sure some of you do. Never ever translate it into rands, or never translate your investment returns offshore like for returns you're getting in South Africa. In Europe, pre-COVID, and even now, I think, the interest rates are extremely low. I think before the pandemic, there was a negative interest rate in Belgium and a few other territories. And so when there's no return from easy money, so bonds and money market, you have to expose yourself to equities. So my outsourced discretionary fund manager, they have a global balanced portfolio, so up to, I think it's 60 or 70% equities. And it has completely murdered the category average. In other words, it has completely outperformed the category average, so all of its peers. It has performed so well over 5 and 10 years. The return, I think, is 4% a year. The average is like something like 2. So people in Europe do backflips about getting 2 and 3% a year in a portfolio because inflation has historically been very low. South Africa inflation is high, 5-6%. Interest rates there are low, between 0 and 1%. South Africa, obviously currently, what's it, 8 point something, 8.25. And so what happens is we get a risk premium, a worthwhile risk premium in South Africa. And so when you invest offshore, yes, there is currency weakening over the long term. It probably counts for 5 to maybe 6% a year. So if your offshore investment portfolio is getting you 4%, you can, over the long term, kind of mentally add 4, 5, 6% to that. And that is kind of what your rand return is, like as a thumb suck. But at the end of the day, when you invest offshore, you will get a lower return. And so when you invest offshore and you bring that money back and use it in rands to pay for your bills, you will have a hell of a shock. And so that is the problem. When we invest offshore, it's to provide for offshore needs, or maybe to bring it back wholesale at some point in time to fund your income. And that makes sense for discretionary investments, so outside of retirement funds. And therefore, within a living annuity, as you can see here, the results have been catastrophic for people with high exposure to offshore markets. I just want to give a bit of credit to all of these investment companies I've listed here. I contacted them all. They all gave me their research. All of the research perfectly aligned with each other. The facts are the facts. And so you might be cynical and say, yeah, well, Allan Gray or Old Mutual, they've got local funds. They want you to invest in the local funds. All of the investment companies I mentioned here have very strong global funds. And so they want you to invest in their global funds, but they just don't want you to run out of money. Okay, so that is me. And so now I'm going to stop sharing, if that's fine. And then I'm going to, and anyone is available to unmute if they want to. And what I will do is I will answer the questions. And I did see a few pop up as well. So let me go to the chat box. Okay, cool. So let me go from the top. Okay, so Charmaine, how are fees in the total return approach? Okay, how are fees deducted? So fees are almost always deducted proportionately from an investment portfolio. You can specify otherwise, though. Some investment providers or some investment portfolios, they might be designed with like a cash account in it where you pay fees from. But realistically, it doesn't make much of a difference because that cash account, say it's got 2% of the portfolio or 3% of the portfolio, it will always be a money market thing. And so what you're doing is you're taking 3% away from equities, you know. And so the rule of thumb, and what the research is showing here rather, is that to take any deductions away proportionately, it fits in line with the rebalancing methodology. And so with the total return approach, the fees would be taken off proportionately as well. And all of the investment platforms allow for that as well. Living annuity does not have to comply with Regulation 28, 100%, although be mindful of the fact that some of them do. And so the living annuities that do comply with Regulation 28 are called in-fund living annuities. I'll give you an example. Say you work for a company, say you work for a mine. I use the mines as an example because they have many thousands of members and they normally have very sophisticated retirement funds. And so you take something like a mining firm, they will have, and all retirement funds, umbrella funds, they have to have an in-house living annuity solution, a default solution or a default strategy for retirees. So say I am actually a blue collar worker, and say I retire and I just ask the benefits consultants on the pension fund to just help me with an annuity. And what they will do is those benefit consultants will help me with an annuity. They will pick an annuity that sits within the retirement fund. Now, that living annuity, it's called a living annuity, but it has to be within the retirement fund. And so it has to play by the retirement fund's rules. And so Regulation 28 does apply there. But if you go into the private market, which I think just about most people do, because the default strategy is actually a new thing, then it is with a life company and it plays by the life insurance rules, and that is the zero limitation. However, what I would say, though, is that there are limitations that life companies have to abide by, and that is the Reserve Bank's laws. And the Reserve Bank says that a life company cannot have more than 45% of its balance sheet or its holdings offshore. And so you might know that if any of you have investments with some of the top investment platforms like 91, Allan Gray, Signia, and a few others, they've limited how much offshore exposure you can have on something like an endowment and a living annuity and a sinking fund. The reason is because with the weakening rand and with the current sentiment, a lot of money has gone offshore on their books and they have to gatekeep. And so they won't allow you to send more money offshore. So even if you have a living annuity on those platforms, you might be limited to 45% offshore exposure anyway. And based on this research, that might actually be a blessing in disguise. Okay, so the next question you asked, what is a good asset allocation at retirement? Shucks. Okay, so this is the tough one because how long is a piece of string? The question is, how long do you need the money to last for? How much are you withdrawing? You will see in the slides, and you will get this on YouTube, you will get the link to this. So you can go back and you saw those rules of thumb I gave, inflation plus. There was a certain range of equities one would have. It really revolves around equities. And so once you get your equity sorted out, the rest will fall in place. But I will tell you this, please be very, very careful if you DIY your own portfolio. I'm a financial planner. I've studied as far as I can get in terms of financial planning with my certifications and such. I did investment planning at a postgrad level, and I am not comfortable personally structuring a person's living annuity. Asset allocation is firstly a science. Secondly, it's an art. Thirdly, you have to be on it all the time because valuations, fundamentals, so much change all the time. Interest rates change in Europe, and that impacts your fund, the investment that you're in. Somehow it will. And we're just not as clued up as the fund managers. For me, it's more about partnering with an investment firm that has a strategy of managing portfolios that you like. You understand how they get their returns. And I'm perfectly comfortable if, picking one fund with one fund manager. There are a few that I can think of at the top of my head, which I won't mention on this call, but it's perfectly reasonable to be very comfortable with the way they get their returns, and then to put your portfolio with them. Then it's been actively managed, but in a way that you're comfortable with. However, diversification is the only free lunch, and therefore you might need a few portfolios. So I would always look at something that is a bit more diversified than just one asset management company. And I would personally never build my own portfolio out of building blocks. Like, for instance, taking X amount of a world equity index tracker, X amount of a bond tracker, X amount of money market. I would never do that myself. Okay, Ron, do you think that the fundamentals driving offshore valuation is significantly different going forward compared to what it was? E.g., that there may be worse ZARA performance looking forward than looking backward? The short answer to this, Ron, it's a very good question. Thanks for the question, is we don't know. There's no way we can know. I did speak the other day, and I'll tell you this, and I won't mention names on this call, but I did speak to a fund manager the other day, a very senior fund manager in the industry, and he says their research shows that the rand seems to be undervalued by 2 standard deviations. Now, I'll translate that. The rand is very cheap, but not fundamentally. It's an emotive thing. And so what that means to me and what it means to them is that they believe there could be a fundamental strengthening of the rand against the dollar, based on various things, obviously, and our political environment and all of that doesn't help. But regardless of what offshore valuations are, if we're drawing money in rands and we plan to use in rands, that becomes less important, as we saw earlier on in the presentation, than the currency risk. And so to have everything offshore when the rand could potentially, in the short to medium term, strengthen a bit, and I mean a bit is like coming from 18 to 16, that's massive. And if you're drawing an income from money that's abroad while that's happening, you're just chopping the knees from underneath your portfolio. When it comes to the valuations of companies abroad, everyone excepting, I think, 30 stocks in America, every other market in the world has been a bear market for the last several years. So the valuations, when you speak to our investment partners and their outlook, they believe that there should be a market correction, which is euphemism for a crash, they believe in the next 12 months on a global level, stemming from the States. And then afterwards, a normal market cycle hopefully will return. But, people said that 12 months ago as well. And as far as I checked, nothing has happened. So it's tough to know what's going to happen. And for us as financial planners, that is a common query we get from clients about what do we believe is going to happen offshore. There's nothing we can do with what's going to happen. And so to have a very nicely diversified portfolio, it's such a cliche, but it really does help, because when something suffers, something else will benefit. There's kind of the seesawing in your portfolios. And so we've seen it now, for instance, in South Africa, equities have been underperforming, but you literally get 8.5% in a money market account. Inflation currently is just over 5. So you're getting inflation plus almost 3. And so there's good along with that potential bad. And if you have a good fund management team managing your portfolio, or you've partnered with, or you've outsourced to a good fund manager, then they are within their portfolio are making all the changes. It's only really when you do your bespoke share portfolios and stuff that fundamentals driving valuations abroad would make a big difference. So I'm sorry, Ron, I know that's like an extremely terrible answer, but I don't know. So, I mean, is a default fund a better option? So maybe, and I'll tell you why I say maybe. And I know if there are any advisors on the call, they'll probably shoot me through the call. But when it comes to, oh wait, sorry, Shireen, it says you have frozen. Let me just check this. Have I frozen? Okay. A default fund option might be better based on, okay, cool. So thanks for confirming. Maybe Shireen, you have some signal issues. Thanks, Mark. Thanks, Charmaine. So a default fund option might be okay on an institutional level because I think especially, and I must watch my words, but maybe for the unsophisticated investor. And so what I mean by that is you're not going to get, when you utilize a default option, you're not going to get any sort of personal financial advice or financial planning help on any meaningful level, I think. You would probably have a meeting from a benefits consultant that works for the pension fund that consults to the company, and they would meet with you once or twice and show you a few brochures, and you would say, yeah, this lines good. I want 5% a year or something, and they would slot you into an option. So I don't think it would be that sophisticated, but the pricing might be good because at an institutional level, pricing of pension funds can actually be very good. So maybe for, that option is worth considering. And maybe if you are looking around at options, you could get a quote from an investment platform like one of the ones I mentioned earlier on, that list of names. They're all investment platforms. You could get it from an advisor, you can get a quote, and then you can get a quote from your in-fund default option and see fees-wise what the difference is. It will vary from provider to provider, and they might have nice fee agreements based on the size of the fund. I just think though that sometimes if you want personal care, you want someone to create or help set something up that speaks to you, then you would need to go and see someone about that or do a lot of your own research until you're comfortable with it. But remember, when it comes to fees, it is one of the two things that is responsible for most of the value destruction in the world. And so it's important to get a handle on fees and make sure when you do invest, the fees are market related. So especially if you have about 4 million invested. Okay, so if you have 4 million invested, is a default option good? I think if you have 4 million and if you need 16 a month or something like that, no, I think you would be fine going anywhere else. If it's going to be tight, in your opinion, what I would do is I would probably go and see someone who can help me get quotes for both life and living annuities and maybe blend the two of them. Because the reason is because at the moment, I just did quotes now for clients of mine who's retiring in December, and I'll be getting fresh quotes on life annuities all the time. And for him and his wife to have joint life annuities, so it's on both of their lives, I think they offered him a rate which was equivalent to 8.4% drawdown on the living annuity. So as a starting income, 8.4% per million. So that is massive. And so you could say, well, fine, maybe I don't have as much to invest, but maybe I have enough to take like a third of it or a quarter. And you can do the math once you get a quote per million, how much the annuity might be. And you can say, okay, fine, maybe it's 25%. I use that to buy a life annuity. I'm getting 8.4%. That's a good bargain. And then my living annuity, maybe I can draw at 5 or 6. And then you've got a nice blend of stable income, and a big chunk of it is guaranteed for the rest of your life. So I don't know if you would get that level of consultation from your benefit consultants. However, a lot of these companies that consult to these retirement funds, they're part of a bigger company like a Sanlam or an Old Mutual, and they've got their whole team of advisors, and they would tap you into that sales funnel. Just remember, with those sales funnels, then you go down the route of speaking to someone who will help you with that company's product. And there'll probably be a heck of a lot of commission charged as well, which isn't necessarily attractive. 3% of your retirement fund going to an advisor is painful, and that's unfortunately what they have the right to do. So always be mindful of those. And to your point, Charmaine, the blending, we call it blending, but when you combine a life and a living annuity, it's extremely powerful. And I will tell you this, not a lot of advisors like it. And not a lot of advisors like it because if you take 20 or 30% of your pension and you use it to buy a life annuity, they can't get that like 1% a year on that. Generally speaking, it's gone. They can help you get it and get some commission up front, but then there's no assets under management, it's gone. And so the rest of your money, if you had say 4 million and now you've got 2 million left, you spend half on a life annuity, they're getting 1% on 2 million and not 1% on 4 million. And so that's where you get those conflicts. So just be mindful of that as well when you go about getting quotes. Yeah, so the initial fees are there on life annuities, but there are some advisors who are happy to just charge you a flat fee to set it up for you, and then you just pay a once-off fee, and then it's set up for you. Great, I'll hang around a bit more. Thanks very much. Thanks for the notes there, Mark. I appreciate it. Another question, would you put your discretionary investment into an RA and then transfer to an LA or GA? Okay, so for anyone who's watching this afterwards and doesn't know what these mean, RA means retirement annuity, LA living annuity, and GA guaranteed annuity. So you actually, and this is another thing, you can buy a life annuity with discretionary money. It's called a voluntary life annuity, a voluntary guaranteed annuity. So when you buy a life annuity, it doesn't need to be compulsory money. It doesn't need to come from a retirement fund. That's only a living annuity. And if you really, really, really want a living annuity, what you can, and if you have like say a million, say you get, I don't know, money somewhere, you got millions and you want it to be in a living annuity, there is an estate duty hack on this, and maybe in another webinar I can talk about it. But if you want to avoid estate duty and you've got millions, you get something called an RA for a day. And your advisor can do it for you, or some companies have like a look-through process where you just dump money into an RA and like the next day it goes into a living annuity. So it's a stepping stone. And so you can get money into a living annuity pretty quickly if you need to. And then there are estate duty implications. And if it all plays out right, you could avoid estate duty. And so that is the only way to get money into a living annuity. A guaranteed annuity, you can put discretionary money in there, and then not everything is taxed. Only the return, the income that you get is taxed. So what they do is they take your ratio. There's a whole calculation we had to work out when we advise clients on this. But there's this calculation we do, and it works out what the taxable portion of that income is. And think of it like this. If you buy a government bond, the income, the interest is taxable, but nothing else is. The capital's not. And so what they do is they use that same logic. There's this ratio we calculate when you put discretionary money into a guaranteed annuity. The income you get, say it's 5,000 a month, 2,000 might be taxable. And what they work out is over 20, 25 years, if you divide by 12, the capital is, and then what they say is, fine, your capital is, say it's 3,000 of the 5,000. The growth, the profit is 2,000. That's what they're giving you for doing business with them. That is taxable. So it is actually quite a tax efficient way of working. And so the rates are the same. So you might get 8.4% right now, relative drawdown, and only a portion is taxable. So it's a very tax efficient way of working. However, the capital is gone. But now this is getting technical. You get whole life life annuities and you get term annuities. You could have a 20-year term or a 10-year term. And there you have, potentially you can get your capital out, but most of the time what they do is you just get a hell of a lot more money out per month. So no capital payout at the end, but you get a higher income. So guaranteed annuities, life annuities are a whole another webinar, but they are an option, and then they're very underutilized. But at the moment, the rates are extremely good. Thanks. Thanks. Yeah, it's an important conversation to have, especially for people who are coming up to retirement or people who are in retirement right now and they have some options available to them. The bond yields are very high right now, and it's worth taking advantage of them. Who would you recommend for hybrid annuities? Okay. Any other questions, or shall we wrap this up? Thanks. I'm glad you enjoyed it. Excellent. Thanks very much, guys. I really appreciate the feedback. I will keep them coming, and you can always contact me to let me know of any other topics you want to talk about. Clearly, life annuities and maybe the art of blending is a thing. So yeah, guaranteed annuities webinar might be on the cards as well. Thanks very much. I appreciate it. I will stop recording now, and then I will distribute this in the next few days via email. And you will also get the links for my previous webinars on those as well. And those are all unlisted YouTube videos, but I will be listing them soon. I will make them available to the public as well. But have a great evening. Cheers.